So let's get started. I'm Matt Fronsky. I'm a Director of Product Consulting and Research at Casina. Recently a DST company. We focus on consulting services for asset managers for distribution, product development, and marketing. And with me today we have a number of panelists from a number of emerging ETF sponsors, and I should say emerging, they're here and they're out, and so let's get their story across. And we'll just start to have them by introducing themselves, and then we'll get going a few questions. Miller?
Thanks, Matt. My name is Jamie Anderson. I'm with Tierra Funds. We're an ETF sponsor. We formed Tierra Funds earlier this year to launch our first product, which we expect to be listed in the next week or two. It's the Tierra XP Latin America Real Estate ETF. It is what it sounds like. My background is actually Latin America real estate private equity. Moved to Mexico City in '93, lived and worked there until 2000. For Arthur Andersen, Deutsche Bank, JER, did a lot of distressed, saw the economic cycle go up and down and back up. Came back to New York, worked for AIG where I covered the region on the global investment side for real estate. And a couple of years ago, my partners and I looked at the landscape in Latin America and we saw a problem, which was essentially you didn't have an option if you wanted to have real estate exposure other than single stock pick, or go through a private equity vehicle where your capital would be tied up for 5, 7, 10 years. And what we wanted to do was to provide a solution, which was essentially to create an index using listed equities in the region with a focus on income and growth and offer that to the marketplace. So in a lot of ways, we didn't set out to launch an ETF. We kind of found a solution to a product, to a problem, and the ETF solution structure found us. We're excited to discuss this a little bit more, but in effect, the product is an income-focused product. The index has a 7% trailing dividend yield. 75% of that is driven by REIT components, which are all listed locally. The other portion of the portfolio are real estate operating companies, so home builders, commercial developers, owner-operators that do pay a dividend, but it's more like a traditional dividend that is an annual or special dividend. We are partnered with ISE Ventures. We were smart enough to know that we don't know enough about this space to go in it alone. We're using ETF Managers Group to white label issue this, and they've all been terrific in the process. And yeah, that's about it.
Thank you.
Great. I'm Kevin Kelly. I serve as the Chief Investment Officer of Recon Capital Partners. Recon Capital Partners is an asset management firm which deploys various strategies across varying investment vehicles. On the ETF side, we have 3 ETFs that are currently out in the marketplace. One is the NASDAQ 100 Covered Call ETF. So that sells index call options against the NASDAQ 100. And generates that current income and pays it out monthly. So year to date, I think we've paid about 7.7% out to shareholders, and so about $1.80 a share. We also have 2 international ETFs that track the premier benchmarks of their respective countries. We have the FTSE 100, which tracks, obviously the FTSE 100 based out of the United Kingdom. The ticker symbol is UK. As well as we have Germany's premier benchmark, the DAX, and the ticker symbol is DAX. So we give direct exposure to those premier benchmarks that wasn't afforded to before. We also, getting back to what the firm does, one of our strategies is using options to help mitigate risk or enhance yield. We do that for a closed-end fund. We're the sub-advisor. It's the Eagle Growth and Income Fund, ticker is EGIF. What we do is we actually do a option overlay strategy to generate income. Eagle is the asset management arm of Raymond James, and we've been excited to work with those guys, and they've got a great portfolio, so we help overlay some options to help increase the income of that portfolio. We also have separately managed accounts that we manage institutional capital for institutional investors to do those types of strategies where we either mitigate the risk or we help enhance the yield. So we think that's an ongoing theme for the next 3, 5, 10 years, where we may have lower equity returns globally, especially if you're looking at a global growth of 2% or below. So we help use options to meet the investor needs. So that's what Recon Capital does, and our ETFs can be found on reconfunds.com.
Thank you.
My name is Andrew Channon. I'm the CEO of Pure Funds. We are also an emerging manager ETF company. My career started on the floor of the American Stock Exchange when all ETFs, for the most part, were listed on that exchange, and had a great experience working my way up from clerk to lead market maker on ARCA for international and global equity ETFs. I then started ETF prop trading desk at another prop trading and floor specialist firm. Was giving a lot of ETF ideas to other current existing issuers, and eventually they said, why do you keep on giving us your ideas? You should try launching your own. We started off with launching thematic natural resource-based ETFs and realized that it wasn't the right market for it. We still have a junior silver ETF and realized that we still like this idea of thematic and wanted to be first to market. And that kind of everything that we've done has been, here's an idea that we really believe in. We want to personally invest in it, or we know people that want to invest in it, but it doesn't exist in an ETF product yet. That's where we found opportunities. And November last year, we launched in partnership with the International Securities Exchange, similarly to Jamie and ETF MG. We launched the world's first cybersecurity ETF. So kind of tilted from natural resources to technology, and realized that there was this massive interest and demand for these thematic ideas, these areas that we think are going to be these drivers of growth in the future, specifically in technology. And we were able to raise over $1 billion into our cybersecurity fund with just a few months after launch, and wanted to continue with this idea of bringing this a diversified basket that would capture these ongoing, growing, future thematic plays. And this summer we followed up with our cybersecurity fund hack with launching the world's first big data ETF, another industry that we think is shaping the way companies and governments will make decisions moving forward. And we think that this is something that we're still in the early stages with. And because of that, because of the volatility that you see in some of these earlier stage industries, that having a diversified basket of companies specializing in the various areas that comprise this theme of big data is a very intriguing way to get exposure to this industry. The last fund that we also launched on the same day as our big data ETF was the world's first mobile payments ETF. Payments and transactions is a huge part of the global economy, and everything seems to be moving mobile, electronic, and digitally. So this fund that we created, the ticker is iPay, IPAY, tracks this other area that we think is constantly evolving, and one that may make more sense for investors to go at it with a diversified play of companies specializing in different areas within the payments and transaction industry, and kind of pure play companies focusing on this. And that's kind of what we look to do moving forward. It's sticking with first mover ideas, thematic that investors want, and that maybe it would benefit them to have this diversified exposure as opposed to trying to pick the 1 or 2 best stocks.
I'm Jeremy Goff. I work for Tortoise Capital Advisors. We're a $14 or $15 billion asset manager that focuses on energy investing across the entire energy value chain, so upstream, midstream, downstream. I'm here today representing our index business, Tortoise Index Solutions, as we've recently, as of June 30th, launched our first ETF, TPYP, which is the Tortoise North American Pipeline Fund. The reason for that being that, I guess we started that business in order to educate the market on individual asset classes and sort of niche asset classes within the energy industry. And so about 5 years ago, we developed 3 indices. One is an MLP index, the other is a North American Pipeline Index, and the third one is an upstream index. And the result of those was really Tortoise Index Solutions. And what we're doing is trying to really educate the market on these different asset classes, and if it makes sense to bring products to market to represent those asset classes. And so that's why we launched TPIPE. We didn't see an effective vehicle in the market that really represented all North American pipelines, the universe. There's a lot of MLP-centric products that are out there, but there weren't any that really focused on the broader North American pipeline universe. And so we felt like bringing a product like this to market would be a great way for a lot of investors to gain access to that particular side of the market. So,
thank you. We've seen about 250 new product come to the marketplace, ETFs in the marketplace. So it's been a fertile ground for new product development. Many of those following currency hedging themes, smart beta themes, Kevin was telling us about his multi-factor smart beta product, and he had a sound story behind that, why he thinks it makes sense. We've heard what you have. So based off the themes that you're trying to capture, why does it make sense for an investment today? Maybe Andrew, we'll start with you, given that you've had such big success within the hack product, HACK.
Thank you. So one of the things that we've noticed is that there are these themes that exist. I've mentioned ours: cybersecurity, big data, mobile payments, and I'll stick with cybersecurity at least initially. And this was an industry where there are maybe over 200 companies that do something cybersecurity related, publicly traded from around the world. And it's an area that I think a lot of people are very familiar with it now due to all the breaches that we've seen, whether Sony, JP Morgan. Just at your company alone, they're probably doing tests to make sure that you're not clicking on fake links, that they're actually sending out themselves just to see what you would actually do in the situation that you see something like that. There are so many different types of companies in cybersecurity that choosing one company, two companies doesn't give you exposure to that. And we've kind of realized this, because it's in the earlier stages, it is growth, that there's significant volatility that can happen. Now, some people will say, well, you shouldn't invest in something because it's volatile. That's only for the risk, the largest risk taking of investors. But saying that because cybersecurity is risky, that's the reason that you shouldn't have any exposure in your portfolio, we don't necessarily agree with that. And kind of what we've noticed is that if you can build an ETF that actually holds 20 plus, 30 plus, whatever that number is, companies that specialize in different areas within this theme that are various market cap sizes in an industry that's so evolving, you can reduce the volatility that the individual investor would get versus picking individual names. And maybe that's actually a way that they should be investing in the space, as opposed to trying to track your portfolio of several cybersecurity stocks or whatever this theme is that you want to make a tactical allocation to. Instead of trying to pick that and then constantly manage it and rebalance, by being able to have this professionally managed and selected portfolio and get exposure through this, reduce your diversification or reduce your volatility through diversification, reduce your individual company risk, and hopefully get the benefits of growth and spending into that overall industry, is something that has resonated very well with investors. So before taking something that was maybe a volatile industry would turn investors off, we found this as a more appealing way to get exposure to these industries that actually may be more volatile as a whole.
I think I'd like to make a point on that. What Andrew really brought was a value-add product to the marketplace that wasn't out there. So if you looked at the ETFs that a lot of people were getting tech exposure to, whether it's the XLK and the information technology ETF, they weren't getting exposure to cybersecurity. So as an emerging manager, you need to bring a value add to the investor, right? That's what they're going to be paying for, right? And that's what's really going to differentiate you in the marketplace. And so our first ETF, that's what we brought, right? We brought institutional expertise to a systematic covered call writing program, right? So for an advisor to do it, it could be costly or time consuming. So we actually removed that component from an advisor and actually brought it onto the ETF. So we actually sell index call options directly to the floor of the CBOE, and it comes at a very advantageous price, right? So if you're paying 60 basis points, that's a great value add for either the investor or the advisor that's putting it in the client's portfolio, because everybody knows that covered calls are a very conservative and safe strategy, but you have to be disciplined and you have to consistently do it over time. So what our value add to the marketplace was, we can bring that product to the 40 Act space and remove a lot of the stigma, the cost, or the convenience, and that's what you've got to do. So I think if you look around at a lot of products that are coming out to the marketplace, especially from emerging managers, they're doing that. So it's actually becoming a great time to be an investor in ETFs because it's become democratized, right? You can get in at a strategy that you want at a very good price, and then you're also offered the advantages of ETFs, where the tax advantages, you can get it out intraday. So there's a lot of great things that are happening in the emerging manager space, especially with the strategies.
So when we looked at the ETF vehicle, since I'm backstopping this financially, I'm not interested in just throwing money down the drain. And I'm personally interested in investing in the product, but more importantly, backstopping this, I really wanted to understand, what's the probability that this can be adopted, right? I mean, it's a great idea intellectually, but, so I think the first factor was cross holdings. I didn't want to see something that you could basically replicate through existing products. In our product, I think it's 18% crossover with two iShares products, tickers of which I'm not going to mention, right? But in any way, you're getting access. It's a big access story here. And I got to tell you, going through the process of getting the custody accounts set up in Chile and Mexico and Brazil, there's value there. It's not easy. But the second thing that I was very concerned with is who's going to buy this. I mean, we obviously want a product that's going to appeal to a US-based financial advisor. So the income and growth piece, I think, gets you there. Latin America can frankly be an issue. The way we're hedging it is that we've identified investor sources coming from Latin America on the institutional and retail side that are emerging, that weren't there 10 years ago, that are looking for new types of strategies to get exposure in the region. A great example is I was at the Latin America Wealth Management Conference in Miami this week. And there's $20 billion just represented at the conference sitting in Miami that is still emotionally invested in having exposure to Latin America. It's a space that, frankly, is underserved by the general investment community, but especially by the ETF community. Another phenomenon in Latin America is the rise of local pension and captive life insurance companies. It's a material amount of money. And they're increasing, I know this is a topic you wanted to bring, this is increasingly looking at the ETF space as a way to provide more diversified exposure. And I think also it's a space that is going to be increasingly looked at by the major issuers.
While you mentioned it before we go on tonight, do you want to address that really quickly about opportunities that you're seeing outside the United States? I think there's not a lot of good data on it, but we're looking at perhaps 10 to 15% of U.S. ETF AUM is actually held by non-U.S. investors. So there seems to be a robust demand for U.S. ETF products.
There is. So in the case of Latin America, I can't speak to globally, but in the case of Latin America, we've researched it very closely. You basically have Chile, Brazil, Mexico. It's $600 billion dollars today. And by the way, this is after like a 45% run on the currency in Brazil over the last 2 years. A 35% run on the Mexican peso in the last 2 years. $600 billion, it's about 15% of Brazil GDP, Mexico GDP. Chile is much more mature, it's 120% of GDP. Each country has its own regulations as to what pensions can do with regards to offshore assets. So the most advanced is Chile. 50% of their pension assets are invested offshore. So it's very easy for them. And moreover, they've got 3 decades of experience doing so. They're very aggressive. Mexico is probably not far behind Chile. It's pretty easy for them to invest overseas. But more importantly, it's very easy to cross-list in Mexico. So one of our strategies will be to take our product after 6 months, cross-list it in Mexico, thereby providing direct access to the Mexican pension funds. They're getting 4% on their Mexican REITs down there. This product's a 7%. It's kind of a no-brainer. Brazil's like a different animal. I think they're probably 5 years behind us.
I can touch base on this. We've entered into a strategic partnership with the largest growing RIA in Brazil. And what we'll be doing is launching an ETF with them. It's bull markets, the select leaders of Latin America. So what it's going to do is it's kind of what Kevin O'Leary was talking about before. It actually has, it screens it for the best performing names with the best payouts, with the least volatility. And actually, that's what you want when you're in Latin America. So we've entered a strategic partnership with them. And one of the reasons why they wanted to come to the US is because we have the most deep liquid markets, right? They're very sound, and we've got the checks and balances that investors globally want, right? So if you're an investor in Latin America, you can come over and trade this product here, and you're getting exposure to your home region that you want. In conjunction with that, we'll actually be launching with them mutual funds down there. So we are a very open-minded firm when it comes to the global marketplace, and we like to have partnerships like this where it can be a symbiotic relationship, but we're seeing it across the board. I mean, just our other international products that we have, the UK and DAX, they serve as a futures replacement because a lot of international investors don't like derivatives. They don't want any synthetics. They want to know you own the actual underlying. And so that's what the value proposition is of the international funds that we have in the marketplace, is that they know we actually own the stocks that are sitting there at the custodian. We're not relying on the futures or derivatives market. So when their market closes and Greece is having a problem, and the futures market is out of whack, you can come here to the United States, our markets are open, and you can trade our products.
Yeah, Kevin makes a great point. I mean, the regulatory environment in the United States is actually an asset for foreign investors in Latin America. They like the safety and the security. And I think as a result, we're going to see most of the growth occur either via cross-listing or feeder funds in the case of Brazil.
I think one of the interesting things there too is that we've seen the ETF market change dramatically, both domestically and abroad, in kind of different ways. Back when I was working on the floor of the American Stock Exchange, it seemed like if you build it, they will buy. Any ETF that you could launch would raise money, within a couple of weeks, and would be self-funding pretty quickly. So it was, just launch an ETF, get it out there. Things changed because of the ways that they were seeded and the specialists versus LMMs. So in the U.S., it's more competitive. It's more difficult. Getting on the various wirehouses and platforms are getting more difficult every day. But one of the reasons that people didn't want to necessarily launch funds abroad was that there wasn't the education or awareness or acceptance there. And kind of what I think we're seeing now, and kind of to what they're speaking somewhat about foreign investors investing in the U.S., I think we're also seeing the foreign investor becoming much more sophisticated and accepting of ETFs as a whole, that there are also opportunities to now bring ETFs abroad, and a lot of the heavy lifting has been done by the larger, earlier firms that have been overseas, where now you can probably bring a product to market where people already understand what an ETF is, and if they like the idea and there's enough awareness out there, they can actually invest in it.
And I think the point we're not actually bringing up is costs, right? So here in the US, costs have come down, whether it's for issuers to launch ETFs, but also for the end investor. So the costs of the ETFs over here in the United States are significantly cheaper than abroad, or even the mutual funds that are abroad. So if you're an international investor and you're looking at fees across the board to get exposure, the US offers some of the most advantageous products to get that exposure at a cheaper cost. So if you're looking across the board to invest, I mean, this is one of the best marketplaces, not only for safety, security, regulation, but also for cost.
Thank you. And I think a lot of people don't really appreciate how difficult it is to bring a new product to market, from the ideation phase to the implementation, bringing it to market. And even once you get to market, there's these really stubborn investors that want to see 50, 100 million. They want to see certain trading volumes. Some investors won't even look at a new ETF unless it's 50 million trading 10,000 shares a day. So what are you doing to support your products and to help investors feel comfortable with investing in your new product? Maybe Jeremy, we'll start with you.
Yeah, sure. So, we've had a lot of experience. I guess we started on the active side of the business. So we've launched a number of, 7 closed-end funds. We've launched 3 mutual funds. We have private accounts. So, we thought that we understood sort of this dynamic of, launching a product, bringing it to market, and what it would be like to raise funds. And I think what we've learned with the ETF space is that, it's a little bit different than that. And I think part of it is you can come to market, with seed, and you can trade, and and I think part of it is educating the investors in the marketplace. That's been the most difficult thing for us, is really just to get the investors to understand that, for example, the screen liquidity that they're looking at is not necessarily the underlying liquidity of the securities that are in the basket that the ETF is holding. And I think also educating them on, again, for us, it's a sector issue. So, we're investing in the energy sector where there's a lot of volatility, and, trying to explain to folks that, that the index, this particular index is well insulated to that. That kind of volatility is something that we're working on. And I think, from a platform perspective, we're also seeing that, we have one ETF out there, and it's hitting those bogeys that you need to hit to get onto these platforms is really critical. But on the other side of it, I mean, you need to be on these platforms in order to raise that kind of capital. So, I think it's been a learning experience for us. And I think, the biggest thing I think for us, what we've seen is just really that is as mature as the ETF market really is, and as long as it's been around, there's still a lot of education that needs to take place in the market.
I think performance is a big issue as well. I think a lot of people, we're talking about the bogeys of 50 to 100 million, but it's also, if you're a new emerging manager coming out and your product comes out and no one's ever heard of you, they don't know what the product is, the first thing that investors see is price and volume, and then you've got to educate them about that, the underlying liquidity. But it's most importantly that the story actually works. What you're communicating to the investment community is actually taking hold. So I'll start with, when we launched QYLD, we have great partners in the NASDAQ and the CBOE. The index dates back all the way to 1994. But the first 6 months was critical. The market wanted to see, are we executing? What's our tracking error? How are we performing? Are we distributing the monthly income? What does it look like? So the minute we hit 6 months, then you started to see assets and pick up as well as trading volume, and then it's just gone up ever since. And fortunately, it's been sticky money because the investors have been able to see we're paying out the consistent monthly income that they're looking to get. So I think that's the number one thing. If you're an emerging manager, that you've got to get it out there. You can have a great brand name. They know you on the active side, but they want to see, can you perform on the passive side,
totally
right? So I think that's the most important thing to take into consideration, is that it's a track record. So once you hit your 6 months, your 1 year, your 2 year, your 3 year, that's going to be really telling, and you've got to be able to because the story's going to play out over different market cycles.
We're quickly running out of time. I did want to, you can address that really quickly, but I want to get one question and go down the panel here and fill that in. We have a lot of money managers in here, and I think it would be fair to say that your product isn't necessarily a core holding at this time, and it has a place in the portfolio. So how would you think about talking to all the investors in this room about where that product fits in the portfolio, about pairing it with other positions? Start with you. Go down.
So I mean, the index shows essentially that it's similar volatility to Mexico's volatility, even though 63% of the components are Brazilian. Realized vol in Brazil trailing 12 is about 39%. That's obviously not something you want to have in your portfolio, right, in a down year. So this product is, given the income and growth components, very similar to a bond type of position like EMB or something, which I think yields like 4.7%, about 20% realized volatility. The Mexico benchmark ETF is like 20% realized volatility. So the layer kind of sits right around Mexico in terms of risk profile. But because of the dividend component, I think that there's an argument to be made that you could complement an existing, EM bond exposure with this, with some growth potential to the upside. And one last thing, there's 60 components. It's very dispersed. Max weight is 3.3%. The weighting methodology is not straightforward market cap. This actually looks at 90-day trading, like liquidity, dividend yield, and then market cap. So what we've designed is a product that gets you maximum dividend exposure without being biased towards any of the large caps, which is frankly an EM issue in most ETF products.
So for the international funds, I mean, they're the premier benchmarks, right? You're getting the two strongest economies in Europe, one in continental and the other is the United Kingdom. So I think investors know how that plays out. For QYLD, I think it's a great, ETFs are tools, right? So this is a great tool to replace either your high dividend stocks, which may be extremely volatile, or this is a great fixed income alternative, right? So let's look at the high yield junk space, right? 18% of the high yield junk space is in energy. Do you want that exposure, given that we've already had about 25 or so E&P producers on the high junk space blow up already this year alone, right? So we know where oil's at. So this is a great way to get exposure to a fixed income alternative, because QYLD owns the NASDAQ 100, right? So if you like tech and you like healthcare, this is a great way to turn those great balance sheets, those market leaders, into a fixed income alternative. You're generating monthly income and reducing the volatility from that. So, Kevin O'Leary talked about, hey, don't lose capital, and he wants payout. We don't have energy exposure. We don't have utility exposure because there's no defensive sectors in the NASDAQ 100. So that's to our benefit, which helps us generate additional income. So there's a way to either, during market gyrations, if you want less market exposure, to the NASDAQ 100, you could use it to take down some of your market exposure because it's lower volatility. Or if you're on the fixed income side and you're trying to find a way to generate high income, this is a great way to displace either junk bonds. So we don't have interest rate or duration risk. So in a rising interest rate environment, we think it fits well in that fixed income alternative bucket.
I'll run through them quickly. So we have a junior silver ETF. Silver is like a high beta gold. The miners are a beta on the actual metals themselves. If you have a high conviction in precious metals for the last 5 years, you've probably been wrong. You're probably hurting. But is now maybe the time that you should start considering adding some allocations to precious metals? Maybe. If you have a high conviction for precious metals, you probably want something that will reward you with that beta if the metals actually move in your favor. And junior silver, for us, a basket of junior silver exploration companies, is a way to get that high beta on the metals without actually owning the metals or having leverage. For other funds, do you think cybersecurity is going to become a more integral part of our economy or less? Are there going to be more cyber attacks or fewer? Will spending on cyber solutions increase or decrease? I've found no one so far yet that thinks cyber threats are going to decrease in next year or the year after that this is a growing thing that's affecting us. And if you want that exposure, your options are pick an individual security or pick a broad-based technology ETF. So what we've done is we say someone that agrees that you want this tactical exposure without picking one or two names and saying, okay, I have that exposure, this is a way for you to get that exposure to cybersecurity. If you looked at the 2015, the large research houses and kind of what their big ideas are for 2015, 2016 and onwards, we're seeing SMAC, social mobile analytic cloud. Our play on analytics is big data. Our big data ETF is the first and only big data ETF, and this is how you can get exposure to 30 plus companies from around the world that are doing different things and giving you this exposure to this growing area of technology. Also, with our mobile payments, it's kind of a hybrid of financials and technology. You're getting these companies that are, yes, you have the card networks, you also have the processors, the solutions, and the application companies. So some of them, you may never see them. They're behind the scenes. Some of them, you might realize the next time you're in your taxi cab and you see Ingenico or Verifone when you're going to pay for your credit card. So these are things that are changing the world, and these are what we're doing to give investors a little more diversification on these themes and to get that tactical exposure for their portfolio.
So T-Pipe is an energy equity play, and the primary reason we decided to come out with T-Pipe was really the fact that we wanted to bring a product that would introduce investors to the energy space, especially in a volatile time that we have right now, to an asset class that is in the long term has low correlation to oil prices. And so these companies have strong fundamentals regardless of what oil is doing. So they're constantly growing cash flow, constantly growing distributions, and it's something that if you look at if you look across the country, I mean, energy needs to be transported, and this ETF is bringing you exposure to those pipelines, 102 pipelines that represent the entire North American pipeline universe. And it's a great way to get access to energy while trying to insulate yourself from some of that oil price volatility, and at the same time getting an attractive yield. Currently the fund is yielding 4 3/4, and that's net. That's the net yield on the product. So you're getting great yield, strong growth, and we're looking at 6 to 8% distribution growth over at least over the next year. And so it's really a great way to get energy exposure, which we believe is important for every portfolio still to this day, and do so in a way that's somewhat insulated to the oil price volatility.
Great. Gentlemen, thank you. Unfortunately, we ran out of time for Q&A, but if you have any questions, please feel free to seek these gentlemen out and ask them any questions any time of the day. Thanks.